If you are not managing billions, you shouldn't copy people who do. Let's watch this Buffett clip.
Hello. My name is Howard Love. I'm from San Francisco. Thank you very much for this weekend in general and this meeting in particular. Recently at a talk at the Wharton Business School, Mr. Buffett, you indicated that you were talking about the problems of compounding large size, which I appreciate and understand. But you indicated, you're quoted in the local paper as saying that you are confident that if you were working with a sum closer to $1 million, that you could compound that at a 50% rate. For those of us who aren't saddled with the $100 billion problem, could you talk about what types of investments you'd be looking at and where in today's market you think significant inefficiencies exist? Thank you.
Yeah, I think I may have been very slightly misquoted, but I certainly said something to the effect that working, I think I talked about this group I get together every 2 years and how I poll that group as to what they think they could compound money at it with 100,000, a million, 100 million, a billion, and other types of sums. And I pointed out how this group of 60 or so people that I get together with every couple of years, how their expectations of return would go very rapidly down this slope. It is true. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation, if they needed it. I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or a billion, at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith's interview a few years ago, if you start with A and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you could, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds, because from $1 million to $10 million, I would say it would fall off dramatically in terms of because there are little, you find very, very small things that you can make, and you're almost certain to make high returns on, but you don't find very big things in that category today. I'll leave to you the fun of finding them yourselves. I mean, it'd be terrible to spoil the treasure hunt. And the truth is, I don't look for them anymore. Every now and then I'll stumble into something just by accident, but I'm not in the business of looking for that. I'm looking for things that Berkshire can put its money in, and that rules out all of that sort of thing. Charlie?
Well, I would agree, but I would also say that what we did 40 or so years ago was in some respects more simple than what you're going to have to do.
Right.
We had it very easy compared to you. It can still be done, but it's harder now. You have to know more. I mean, just sifting through the manuals until you find something that's selling at 2 times earnings, that won't work for you.
It'll work, it's just you won't find any.
Yeah.
Zone 10, please.
So, Buffett's point is simple. Small money can go where big money cannot. That is an advantage if you choose to use it. Mega caps like Nvidia and Apple are amazing businesses. But for a small investor, the edge is usually not there. They are crowded, covered by armies of analysts, and priced with very few blind spots. Your best odds come from a different game. First, hunt where coverage is thin. That means small and mid-sized companies, spin-offs, special situations, owner-operators, regional leaders, and boring cash machines that get ignored. Fewer eyes means slower price discovery, which gives you time to think and act. Second, use the larger pool. There are thousands of underfollowed names. You only need a handful of great ones over a few years. Let selectivity do the heavy lifting. Pass on almost anything and then move with conviction when the work lines up. Third, Do the primary work. Read filings and footnotes, listen to calls, build a simple model that connects unit economics to cash flow, and track how management allocates capital. That is very important. I want high returns on the capital that stays in the business, a runway to reinvest at good rates, and proof that $1 of retained earnings creates at least $1 of value over time, which is the Buffett test. Fourth, align with the owners. I lack skin in the game, rational incentives, and a clean record on dilution. Insider buying is a great tell. Debt should be serviceable through a normal rough patch, not only in perfect business conditions. Fifth, keep it practical. Price matters, but quality matters more as holding periods get longer. I try to buy businesses that I can hold through the noise, then let compounding work, and believe me, there will be noise. I also avoid chasing headlines, trading every quarter, or pretending I have an edge in the most popular names on earth. This approach has worked nicely for me so far. I have beaten the S&P 500 over the last 3 years by a wide margin while consistently sharing my holdings every quarter in real time on Twitter and at real time on Patreon. That does not guarantee the future, but it tells me the process is on the right track. If you want to see how I apply this in real time, I share my portfolio and full analysis of the companies that I own on Patreon. I also post tracking tables and updates that go deeper than YouTube. The link is in the description. Thank you for watching. If you like this video, please do YouTube things. See you next time.